All right. Well, I'm sorry to do this, but I'm going to have to do a recording today. So we'll walk through some of the slides and some examples together. And yeah. So here we go. So we're on to chapter 16. Welcome to the pension chapter, where we'll look at the two different kind of pensions, being defined contribution and defined benefit plan. And first of all, let's define what are pensions. So pension is typically an arrangement where an organization that you work for offers some kind of benefit to you after you retire. And it could be continued salary, it could be a benefit plan, whatever that might be. So, excuse me, there's a way to determine what those costs are, how to record them, and how to reconcile those pension components. So your typical pension plan setup, the employer or the company you're working for sponsors the pension plan. It incurs the costs and pays any contributions. So it provides funding to another outside entity or a trust in order to provide those pension benefits to employees post-retirement. The custodian or the fund entity, you might hear those different words, they receive those contributions, they administer the plan and make any benefit payments. So very often you'll have your organization will have an arrangement with an outside organization who would receive those contributions. They would invest, within the guidelines provided, and then when you retire or start to take a pension from that plan, they would actually provide the payments, not your previous employer. And there are different terms used when we're talking about pensions. There's a funded or not funded, there's contributory or non-contributory, which typically states that you as an employee would provide a portion of your salary into the plan or not. So contributory is typically where you as an employee would put funds in as well as your employer, but non-contributory typically means that the employer only contributes. As I said, there's defined contribution and defined benefits, and we'll talk about what those are in a moment. So defined contribution, typically within your employment agreement or within your HR policies, will specify the amount that the employer will contribute. And sometimes it's a flat amount, sometimes it's a percentage of your gross salary. And it indicates that they would contribute as the employer with possible contributions from you as an employee at a fixed or maximum amount. So in this case, give an example, you have a salary and they say that they will provide up to 5% as into the defined contribution plan, matched by you as the employee. In this case, those contributions, if you choose or are required to, you would make the 5% off of your salary. The company would put in the 5% to match. So 10% of your salary would go into the defined contribution plan. In defined contribution plans, it does not indicate what your future benefits are. That means whatever the value in that plan is, the risk is on you as the employee, not the company. So in a defined contribution plan, there's no guarantee on what the value is at the end of the day. Again, there's still a third party or trustee that manages those funds and typically would distribute them to you. But again, reminder, defined contribution, you as the employee would determine the investment strategy, and because you're taking the full risk. Under the accounting side, the liability is only reported if the required contributions have not been paid in full. So there's no liability on the company's behalf unless they have not sent the funds to the trustee or the pension holder. The pension expense is known because it's stated in policy or employment agreements as far as, X% of salary, whatever that might be. So there's no, crazy calculations like we will get into in a moment for defined benefit. So I'm going to move over to defined benefit pension plans. So defined benefit pension plans will dictate what benefits are expected to be received by employees in the future. So for an example, you might be told, you'll get 1 or 2% of your average annual salary at retirement for every year of service. It could be something as simple as that. So say you make $50,000 a year forever, and you get 2% per year of service, so $1,000 per year, and you work there 30 years, at 30 years, you would expect to receive $30,000 per year in pension. In a defined benefit pension plan, the employer assumes the risk. Otherwise, if the plan requires more assets in order to fund pension payments in the future, it's the employer that has to fund those shortfalls. Contributions are still made to an outside party, but they will get reports based on what the actual assets are versus what the predicted liabilities are in order to fund the pensions. Now, the cost to the employer can be a little more difficult to pen because you have to make assumptions. How long will people live? When will people retire? How many years of service might they have? What kind of investment return they'll be on the plan? And defined benefit pension plans will require an actuary. Actuaries will look at those different variables and assumptions and determine a best estimate or range of potential obligations. And any expense recognized in a defined benefit pension plan is not necessarily the same as the contribution. So every year, an employer will send a certain amount of funds into the plan that doesn't necessarily match your expense. There are other calculation components. So in order to get there, we have to look at what the defined benefit obligation is. So we always look at what was the obligation last year. We look at any current service costs. So we just say had another year passed and we know it's going to cost us $200,000 more for the current service. Plus there's an interest cost. Okay, so there's an expected yield or expected rate of growth in that plan. Then we can remove any benefits paid to retirees. Then if there were any past service costs or changes to the plan. So maybe at the beginning of the year, we said, you know what, we're going to provide something extra to future retirees, and it's going to cost us X dollars. So we have to make those adjustments. And then this last piece is any actuarial gains or losses. So it looks at the difference between what was the expected interest cost versus the actual interest gained or lost. So there'll be a calculation, and we'll walk through an example of that later. And that'll determine the defined benefit obligation at the end of the period. Now let's look at the definitions just to make sure we're clear. The current service costs are costs of the benefits that are provided in the future in exchange for services provided in this current fiscal year. Interest costs, we talked about. The only difference here is under IFRS, it uses the current market rate versus ASPE uses the settlement rate or the current market rate. Benefit paid to retirees, self-explanatory. So any payments that are sent out to retirees is a straight reduction. Past service costs we discussed. Okay, so sometimes there can be a decrease in obligation or an increase. And then the actuarial gains or losses. So when we reevaluate the plan and look at what the interest cost should have been versus what it was, there might be an adjustment accordingly. So under the defined benefit pension plan side, so you'll have your plan assets. So those assets are set aside in a trust and typically in a legal entity separate from the employer. And they're restricted assets. They can only be used to pay those benefit obligations, pension or post-retirement benefits. So now we've determined the defined benefit obligation. We need to also understand what the plan assets are. To determine that, we look at the fair value of plan assets at the beginning of the period, plus any contributions we actually sent over. So this is actual cash sent to the plan. And add or subtract any actual returns. So we look at the plan assets, what did we actually earn on them or lose? Minus any benefits paid to retirees equals the fair value of the plan assets at the end of the period. Looking at the definitions again, kind of covered this, contributions, okay? So, you know, we sent $90,000 over to the plan, that'd be our $90,000 contribution, etc. Just a note here on the actual return, you always look at the income generated less any administration costs. So say, you know, the plan assets generated $50,000 of income, but it cost you $5,000 to achieve that, you'll only record the $45,000 as your actual return. Now that we've calculated defined benefit obligation and the plan asset value, we can determine whether it's funded or underfunded. So if you take the defined benefit obligation at the end of the period and subtract the fair value of the plan assets at the end of the period. If the obligation exceeds the plan assets, then you're underfunded, which means you don't have enough assets in the plan to cover the estimated obligation. And the opposite is true as well. Sometimes you might have more assets than your obligation, and therefore it's overfunded. You're always in a better position to be overfunded than under, but at the end of the day, you want to be as close to balance as possible. Now, to determine your pension expense under defined benefit pension plan, you'll look at your past service costs will be a current expense, plus your current service costs, plus any net interest or finance costs will become your expense entry. Now we'll look at a pension worksheet shortly. We'll come back to that. And then another component is about remeasurement. So there's a remeasurement gain or loss that represents the difference between the actual plan and the return calculated using the discounted rate. So there's always the discounted rate is what is expected to be achieved in the plan, and the actual is the actual. So there's typically a difference between those two. Under IFRS, any remeasurement gain or loss, any difference between those two rates, is to be recorded as other comprehensive income. Under ASPE, you include that remeasurement with the pension expense. So you don't record that under OCI. And some other components of pension expense that require separate disclosure: any asset gains or losses, so any difference between the actual return and expected return, we just talked about that. Any actual gains or losses, past services costs. Okay, so any of these components that you may incur, you would typically disclose, or actually be required, sorry, not typically, you'd be required to disclose in the notes to your audited financial statement. And all of them are considered non-recurring. All right, so what I'd like to do then is let's move over to some questions, and we'll walk through, how to complete them, and then we'll look at a pension worksheet. So our first example here says a company contributes 6% towards the pension plan of their employees. The company has a defined contribution pension plan. If salaries in the month of February are $124,500, how much is the expense? So in this case, we would take the $124,500 times the 6%, so 0.06, or 6 divided by 100. So our pension expense for the month of February would be $7,470. We know the salary, we know the rate, we can calculate it. No more complicated than that. Question 2 says, if the company remits or pays the contribution in March, what's the entry in February? So in this case, we would look at our pension expense. We need to record that. So it'd be a debit to pension expense for the calculated amount, $7,470. And because we're not paying it until the following month, it would be a pension liability. So it'll sit in our accounts payable, typically under current liabilities, because we'll pay it next month. Number 3 here says, in June, a company pays their employees $350,000. The employees contribute 2%, and the employer contributes 10%. what is the entry for June? So the employer remits the contribution in July. So let's first of all do the entry for the wage expense. So let's assume no other reduction from the wages. I know it's not real, but let's assume wage expense was $350,000. So we need to debit our wage expense for the amount that we've paid the employee, $350,000. Let's assume the only deduction is the 2% pension liability. So we'll go equals $350 times 0.02. That gets you your $7,000 pension liability deduction. And then for the cash sent to the employees would be the difference. Now we know there'd be income tax, CPP, EI, and all those other good things, but let's just bear with me for a second. Then the employer needs to record their contribution. So in this case, we will have a pension expense and pension liability. To determine the pension expense, then we need to take the $350,000 in salaries times 10% required from the employer. And that becomes our debit to pension expense and a credit to pension liability. So in this case, our total pension liability for the month of June will be the $7,000 plus the $35,000. So in July, we will remit the sum of those two, being $42,000 to our trustee. Next question, what does DBO mean? Because you'll see this acronym often in this chapter and in real life. DBO stands for Defined Benefit Obligation. So let's move on to question 5. If the DBO is $250,000 and the plan assets are $200,000, is the plan over or underfunded? So thinking about our lesson a few moments ago, if our obligation in the future is estimated to be $250,000, but we only have $200,000 put aside, we owe potential more money than we've actually funded. So therefore, it is underfunded. Okay, I'll add this little note here. Question 6, we look at our defined benefit obligation, almost 1.9 million. Our assets of 1.6 and change. So do we have a net defined benefit asset or a net defined benefit liability? This is similar to the over or underfunded. So first of all, we need to determine the difference between the two. So we'll take the 1.896 plus the 1.641. So we have a difference of 255,000 and change. To determine whether it's an asset or a liability, if the DBO exceeds the assets, it means we have a liability because it's underfunded. So we would expect that we owe the plan $255,000 more in order to properly fund it, the obligation. Moving on, number 7, a company follows IFRS. Plan assets are $1 million. The discount rate is 5%. The actual return on the plan assets are 52.3. What is the remeasurement amount? So if you recall, we have to look at the actual return versus based on discount amount. Our actual return, we're told, is 52,300. Our discount rate is 5%. So our discount rate means we take the plan assets of $1 million times the 5%. So our discount rate or expected return was $50,000. In this case, we look at the difference. And because our actual return exceeded our discount rate, we actually have a 2,300 positive gain remeasurement amount. Gain, I'll type that in. Gain or remeasurement. Because our actual exceeded our expected. number 8, it says during 2021 for a defined benefit pension plan, a company had service costs of $32,500. Interest expense on the obligation was $12,300, and interest earned on the plan assets were $96,000. What is the pension expense? I don't know if you recall the little slide we just looked at a few moments ago. We looked at service costs then. There's no past service costs. We have service costs of $32,500. We have the interest expense, which is the expected amount, of which we're told is $12,300. And then we have the actual interest earned, and the $9,600 reduces the obligation, or sorry, reduces the expense. So then we can sum that up to determine that $35,200 is our pension expense for the year. So we look at service costs, plus or minus any past service costs, which is 0, add the interest expense, which is what was expected, less any interest earned, which we're told, equals our pension expense. Let's look at another example. During 2021, a company that has a DB plan, had an opening plan asset amount of 1.2, contributions were 500, interest earned was 30, and benefits paid were 100. What's the ending plan asset amount? So our opening plan asset was 1,233. Okay, we're told that. Our contributions, we're told, are 500. So we're looking at the asset side, not the obligations. The interest earned was 30. And our amount paid to retirees was $100,000. So we sum up those components. This is our asset, not our obligation. Opening plus contributions, plus any interest earned, less any payments made to retirees, equals our closing plan assets of $1.663 million. In this last example, before we look at a worksheet, it says during 2021, a company that has a defined benefit pension plan had an opening DBO amount of $600,000, so the obligation side. Interest costs were 20, benefits paid to retirees was 56.9. And because we're told that there's no other interest calculation, we're assuming the interest cost equals the actual. So the expected versus actual are the same. So our opening was 600. Our interest, oh, all of a sudden my keyboard isn't working. Oh, there we go. Interest is 20,000. Payments to retirees. So we'll add that up again. We have 563,100 in this case. All right, so let's jump over to one of the chapter 16 examples, and we'll look at example 1. So example 1 is a company, Moon, that uses ASPE, and we're given a bunch of data about their pension plan. So I've set up the worksheet down below. Okay, so this is the same worksheet you'd use for any DBO process. And so we need to look at a couple different components. We will look at the defined benefit obligation versus the plan assets, and we'll do our calculations from there. So first of all, let's start with our opening balances. We've got our defined benefit obligation at $1,370,000, and that is a credit, okay, because it's a liability, it's what we owe. The plan assets opening, 1.48, and that is a debit. Okay. So then our net defined benefit would be the difference between the two. So, and in this case, our debit is greater than our credit. So our assets are greater than our obligation. So there'll be a debit balance on our books, which means it's an asset on our organization's balance sheet. So this is on our balance sheet. Now we can go through the current year calculations. So we have our current year service cost, we're told is 94,000. And that is a credit. And I just realized the formatting is not consistent. Let's fix all that. Like this. There we go. And then we have a past service cost, which was granted on January 1st. So we have to add that to our obligation. Oops. Clicked on the wrong button. Sorry about that. So it'll be a credit to increase our obligation. Our interest cost, we have to look at the discount rate. So we're told our discount rate is 5%. And our discount rate, excuse me, we would calculate that on our opening balance plus any past service costs times the discount rate. So our current service cost is not a component of this formula. So we'll have 77,250 as a credit to our obligation. Under our obligation then, we have our benefits paid. So we paid out 26,000, and that is a debit because it will reduce the obligation. On our closing balance, we would add all the credits, subtract all the debits. Let's do it this way. We'll go credits minus the one debit. So we have 1,690,250 as a credit obligation. Now let's move on to the plan assets piece. Here we are in the plan assets. We have an expected rate of return on the assets. We're told here is 5%. So we'll go our plan assets times our expected rate of return, 74,000. So we're expecting our plan assets to grow by 74,000 that year. We sent over a contribution of $90,000. So that increased our plan assets. We paid out from our plan the $26,000, but in this case, it is a credit to our plan assets. We reduce our assets, and you'll see that this is a balanced entry between the two components. Excuse me. For the remeasurement piece, we looked at the expected versus actual return. So in this case, we need to look at our expected rate was 74,000 at 5%. Let's do a little table. So let's go expected versus actual. Expected we have already calculated, which is the 5%. The actual is 6%. So we can take 6% of our plan assets. The difference would be our remeasurement. And because the actual exceeded our expected, it is an additional debit to our plan assets. So the sum of the expected rate plus the remeasurement should equal our actual. And that's all our entries for our plan assets. So in this case, we've got, let's just do it this way, our debit plus our debit plus the debit plus the debit minus the credit is 1,632 as a debit balance. Let's move it across. Now we want to make sure every row is a balanced entry between the different components. So the current service cost we already talked about becomes part of our pension expense. Therefore, it is a debit to pension expense and a credit to the obligation. Our past service cost is also part of our pension expense. So it'll be a debit to pension expense. Our interest on the obligation is a debit to pension expense. So we've got all these lines in balance. Then our plan expected rate, on our plan assets becomes a credit to our pension expense. because we're planning on, by the money that we invested in the plan is expected to grow, so it reduces any pension expense. The 90,000 we actually sent physical cash, okay, to the plan asset trustee. Benefits paid came out of the assets, so no impact on our internal financial statements. The remeasurement also becomes part of pension expense if this was under IFRS, or sorry, yeah, under IFRS, it's part of pension expense. And under ASPE in this case, it is as well. So we have our 14.8 is a credit because we earned more than we thought. And yes. And then now we move down to our journal entries. So right now, defined benefit obligation plan assets are not on our financial statements. But these items are our cash account, our pension expense for the year, and our net defined benefit. So we need to balance off these journal entries. So we look at our pension expense. Let's determine what that amount is. So we'll add our debits. Oops, this one, minus our credits. So we'll have a debit to pension expense for the year of $257,450. And that will be a entry to our net defined benefit as a credit because we need to balance the journal. It'll be a credit to our net defined benefit and a debit to pension expense. Now we need to determine our funding journal entry. In this case, we only have one contribution. So we need to credit cash. And we need to debit our net defined benefit. So our net defined benefit at the end of the year, we take our opening debit plus our debit minus the credit. It becomes a negative, which means if it started as a debit and it ends in a negative, which means it's now a credit balance, and we can then flip the sign because our credit is bigger than the sum of our two debits. So on our balance sheet at the end of the year, our net defined benefit that used to be an asset is now a liability because our obligation exceeds our assets. So a few things. First of all, we need to state in our notes that the plan is underfunded at the end of the year by the $57,450. So the previous year, we would have said the plan is overfunded by $110,000. And then our journal entries for that year, we would then have a pension expense debit for the $257, a defined benefit account. Let's go credits over here. And then we'd also have the net defined benefit for the contribution from cash, credit. And those are our journal entries related to the pension expense and contributions for the year. All right, we're going to flip over to example 4, but I'm actually going to pull up the answers and we'll walk through it because pretty much the exact same as example 1. The difference here is we are using IFRS and we now have an OCI column, the other comprehensive income column. And the only difference in the whole question here is the remeasurement line goes to OCI, not to pension expense. So let's just follow the math. Our opening defined benefit obligation, 1350. Opening plan assets, 1510. So our net defined benefit had a debit, so it was an asset or overfunded at the beginning of the year by $160,000. Our current year service cost, $87,000. Let's do it line by line this time. So it's a credit to our obligation, and it's a debit then in our worksheet to pension expense. Our past service cost, we're told, is $193. So we will credit our obligation, debit our pension expense. Our interest on the defined benefit obligation would be our discount rate of 5% times the opening balance and the past service costs. So make sure your order of operations are correct. Add those two times 5%. Credit to our obligation, we're increasing the amount that we owe our employees in the future, and a debit to pension expense. Moving down, we have an expected interest on our assets, which we're told is 5%. So we take 5% of our opening plan assets, debit, and that becomes a credit to our pension expense. Looking at our employee contributions, we're told we're $94,000. So that's an add or a debit to our plan assets, and it's a reduction to our cash. Then we have benefits paid in the year, $26,000. So we will reduce our obligation debit, and we'll reduce our plan assets credit, $26,000. Then we have the remeasurement. So there's a difference of 1%, expected versus actual. Same kind of table as before. Based on the expected rate, we had 75.5. Based on the actual rate, we have 90,600. So if we follow the math, it's the plan assets times 6%. So the difference, and because the actual exceeded the expected rate, it's a debit to the plan assets, which means our assets went up in the plan faster than we thought. But in this case, it's a credit to OCI. So it's actually revenue under other comprehensive income. Now that we've gone through all the components in this example, we would do the same kind of summary. Look at our pension expense. We now have $281,650, adding our current service, past service, our discount rate, less any expected rate would give us $281,650. Our other comprehensive income would be a $15,100 credit. And that would all be a net credit to net defined benefit of $266,550. Looking at our employer contribution would be a credit to cash for 94 and a debit to net defined benefit for 94. So in this case, we went from an overfunded position of 160,000 to an underfunded position of 12,550 because it's our obligation exceeded our plan assets. And just to visualize the journal entries then, we will have a debit to pension expense, a credit in this example to OCI, and that could go debit or credit to OCI. Because if our actual rate was less than the expected return, this entry would be a debit to OCI. So you have to really pay attention which one is bigger than the other. And the net of this journal entry then goes to net defined benefit. And then we have our contribution entry of 94,000. Well, that covers basically the examples. We'll just do it over and over and over and over again. So if you have any questions, please reach out. Otherwise, take care.